as we come through the midpoint of the year and people are sort of looking at or reviewing their portfolio, one of the topics that comes up here to start to explore is the concept of tax loss harvesting. Now let me explain what that is and then I'll give you an example. Tax loss harvesting is essentially selling an investment that is at a loss and using that loss to offset a gain in another investment or a future investment. Now, historically, on an annual basis, the IRS lets you take $3,000 in losses off your income. Let me just put that over here. So if you made $100,000 and you had some losses in your portfolio, $3,000 you could take off your income. So you'd have $97,000 of income and then you'd go from there. Now, what happens if you had a $10,000 loss? You'd use the $3,000 of income, but that $7,000, it goes up here in this tax loss bucket, I call it, okay? Now, in the future, when you look at your portfolio, if you end up selling off a chunk and you have gains over here, maybe you have gains of $10,000, you can go ahead and reach into this bucket in that given year and you can offset the gains with these losses and you'd only have to pay taxes on a gain of $3,000, okay? So this is kind of the math on the concept of tax loss harvesting. But let me give you a specific example. Let me find my eraser here. Here it is. Okay, so let's say you had a position in Coca-Cola. This is the ticker symbol for Coca-Cola. But let's say you had $10,000 invested in this stock, all right? And for whatever reason, the stock went down 30%. So now this $10,000 is worth $7,000, okay? Now, until we sell this security, sell these shares of Coke, there's no taxable transaction here, okay? I just want to clarify that. So this is just a paper loss. Now, maybe the news on Coke is so, I'm just picking a name here, but maybe the news on Coke is so bad that it's going to stay down for a while, okay? So you can elect to sell the stock and you can move what we call laterally into a similar position. So let's just say you buy Pepsi. I think that's the ticker symbol for Pepsi. So you put $7,000 into Pepsi. Now, what's happened? We've sold the stock. We've now realized a $3,000 loss, which comes up into this bucket over here, okay? But now we have $7,000 over here in Pepsi. Now, one of the things that you learn in investing is something we call correlations. Coke and Pepsi are going to move traditionally similar to each other because they're in the same sector. They're part of the same asset class, consumer staples, if you will. So, I'm not saying if Coke goes up 10, Pepsi's going to go up 10. But if Coke went up 10%, Pepsi probably go up somewhere between 8 and 12. Historically. It's not an absolute. I want to be clear about that. So what people do is they take this loss here, they reposition the asset into something that's very similar, in this case Pepsi, and then when they write it back up, okay, let's say they just get back to that original position, they don't have to pay gains on this $3,000, okay? Now, in this scenario, you're just getting back to even, right? Or this would be a gain, but you're getting back to your original investment. So these things would essentially wash out. But if Coke stayed flat after you moved out of it, and Pepsi went up, let's say it went up to $20,000 in value, okay? You'd now have a gain of $13,000, all right? And that $13,000 could be offset by this $3,000 that we put in this bucket, and you'd only pay taxes on $10,000. I know I got a lot of numbers up here, but the point is that if Coke is suffering, we can take a tax loss in it, move it over here into Pepsi, play the recovery, and then the gains that we ultimately have, because this stock is actually moving and producing gains, we hope, are offset by the losses that we used here. Okay? So that's just an example of tax loss harvesting. Now, when we have multiple positions and we have across many different types of accounts, this bucket, we can make some shifts and really build up an arsenal of losses in here, but still have that same exposure in your portfolio, so that we can use those future gains to be offset with those past losses. And that's the lesson behind tax loss harvesting.